Hello and welcome. I'm James Woodburn, publisher of Jim Rickards' Strategic Intelligence here in Australia. Today I'm joined by the man himself, straight from his self-sufficient mountain farm in New England, as well as our Australian investment director, Nick Hubble, zooming in from his bolt hole in London. Now, I requested this call because the crisis we are seeing is something that Jim has not only called years in advance, but is also something he and Nick have been helping prepare readers for and position their wealth for a long time now. So right now, the vast majority of the world is under lockdown, both physical and economic. Stock markets remain open as of today, Thursday, 2nd of April, although that could possibly change at any moment, and we'll talk about the outcome. The health pandemic that sparked all of this was really the element of surprise, but the freeze on huge parts of the world's economy is actually something Jim warned about back in 2016 in his book, The Road to Ruin. So I thought, Jim, let's start with you. Is this the first stage of Ice 9, do you think?
It could be. We're certainly dangerously close, and we'll have to watch it carefully. But just for the benefit of the viewers, maybe I'll just take just a minute and explain what Ice 9 is. It's an idea that I nicked from Kurt Vonnegut, who wrote a novel in the 1960s called Cat's Cradle, which I highly recommend. A little bit of dark, we call it dark humor, dark comedy. But in Cat's Cradle, there was a physicist who created an isotope of water called Ice 9. It had the following properties. It was frozen at room temperature, but if a molecule of Ice 9 came in contact with a molecule of water, the water turned to ice. And you had a small vial, and if you poured it into a stream, let's say the stream would turn to ice, but then through contact, so would the rivers, and then the oceans, and then all the water on Earth, and then life on Earth would die. So it was a doomsday machine. Of course, this was written during the height of the Cold War, when we were all worried about nuclear war. So what I did, I took that concept and brought it over to capital markets. And I made the point that you can close a particular venue if you have disorderly trading. So let's say the stock market's crashing, the circuit breakers don't work, and they decide to close the stock market. Well, they can do that, but it doesn't alleviate the demand for liquidity. People will simply go over to the money market and say, well, fine, I'm redeeming my money market funds. So then you have to shut the money market funds. And then it goes over to the banking system, and people queue up at the banks and just try to take all the money out of the banks, and then you have to shut the banks and so forth. In other words, there's a kind of financial contagion to go along with our viral contagion that we're facing now, where every time you close something, the pressure goes to another venue, and then it has to be closed. And eventually you end up shutting down all the markets, banks, stock exchanges, et cetera, in the world, at least temporarily, until you come up with some kind of solution. So that was the idea. It's interesting to see that Ice 9 has now become part of, I would say, standard financial jargon. I see it all the time. They don't credit me, let alone Kurt Vonnegut, who came up with it. But that's okay. It's useful. It's more than a metaphor. Actually, the math is the same, and it has become parlance. So, my book, The Road to Ruin, from 2016, described this phenomenon. My latest book, Aftermath, came out last year, but this book, The Road to Ruin, interestingly, like any author, I check the Amazon rankings every now and then. The Road to Ruin is selling even faster than some of my other books, even though it's a few years old, because it does have this explanation of Ice 9, which we just talked about. And then people say, well, that will never happen. And I remind them, no, the New York Stock Exchange was closed for 5 months, from August 1914 to December 1914, at the beginning of World War I. In 1933, our President Franklin Roosevelt closed all the banks in the United States by executive order, all of them. He didn't say when they would reopen. In fact, they reopened about 8 days later, but no one knew that at the time. They used the euphemism, the banking holiday. Well, it wasn't a holiday. They were closed by orders. In 2013, all the banks in Cyprus were closed. In 2015, all the banks in Greece were closed. People in Athens were flying to Frankfurt with empty suitcases, filling them up with physical paper euro notes, and flying back to Athens because the banks were closed. The ATMs were shut down. The credit cards didn't work, et cetera. And so all these things have happened before. They happen under duress, under stress. But the idea that that would never happen is not true. And then all I've done is take that a step further and say, yeah, and it can be worse than that because they can be kind of closed down sequentially, at least until monetary authorities come up with a solution. So we're seeing the very early stages of that. We've seen a couple of trading halts on the New York Stock Exchange. That's not the same as shutting the exchange, but we hit these circuit breakers. The floor of the stock exchange is closed now. I think most people know that 95% or more of the trading is robotic. So the computers are doing fine, but the floor of the New York Stock Exchange right now is closed. I went to a bank the other day; it was closed. Now there were other offices elsewhere. I can do online banking, but the banks are closed, not by government order, but just because of the virus. So we're seeing it happen in certain ways, and I think people who assume it can happen take too much for granted.
Well, you mentioned the 1930s there, and that was really like a proper shutdown from the highest level. So maybe I'll bring Nick here. And do you think we're seeing something similar? Is this essentially is this a bear market, or do you see a greater depression at play? And maybe Jim can expand on that as well after.
Yeah, I'm going to steal Jim's metaphor, really. We're all looking up at the sky wondering which snowflake is going to trigger the avalanche. We should all be looking at the snowpack, looking at where the avalanche is going to happen, regardless of what the snowflake is that triggers it. And there's so many different things that could go wrong right now. Jim profiles them every month, every week. We've been, laying them out in front of readers for so long now. But what coronavirus has done is trigger all of them at the same time. They're all in play. All of the things that we've written about, that we've researched and looked into over the years, they could all go wrong. And chances are some of them will go wrong. And so in the end, you need to be looking at where the real threats are other than coronavirus, and you need to be focusing on what the financial threats are.
Would you agree with that, Jim?
Yeah, I do. And just to take it a step further, this is not, well, I'll speak specifically about the United States and Europe, but good reason to believe similar things are happening in Australia. This is not a recession. This is a depression. So you look at 2008, you can look at 2000 in the US when we had the dot-com crash. You can look at 1998 with the long-term capital management in Russia. You can look at 1994 with the tequila crisis in Mexico. None of those financial panics or drawdowns really are the proper baseline for understanding what's going on now. You have to go back to 1929. You have to go back to the Depression and the Great Depression. And I remind people that in the Great Depression, the Dow Jones Industrial Average, our main stock market index, fell 89%. Not 30% or 40% or 50%, but almost 90%. It was exactly 89.2%. That's what a depression looks like. That's what a real bear market looks like. So our stocks are down 30%. Okay, that's a lot. That's a lot of lost wealth. It's a shock to most people. I've heard of people getting their we have these 401k plans, tax deferred savings plans, like a little personal superannuation fund. And people are getting their monthly statements in the mail and they're just putting them in the trash. They're afraid to look at them. But that's pretty bad. But that's nothing compared to what happened in 1929. So down 30%. Okay, that's bad enough. But imagine down 40%, 50%, 60% or more. That's what we're looking at potentially. This is one of the questions I'm asked most frequently lately is, is the bottom in? Is this a safe time to, kind of go back in the water and buy stocks? And my answer is absolutely not. I mean, yeah, you'll have a couple good days or little 3-day rallies here and there, but the bottom's not in. This is just the first wave of repricing by the stock market with much more to go.
Well, you mentioned to bring it back to Australia. I mean, that the stock market here is down 40% from the peak in late February. But also another record that Australia holds is that we've got the highest or the largest household debt in the world. Mm-hmm. And the lion's share of that debt is held by the banks. So what happens, perhaps that's a question, what happens when the financial freeze potentially hits the banking sector?
Well, the first thing that happens, of course, is people just can't pay. I mean, you want to pay, you want to stay current, but if you have a large debt, particularly in credit cards or, some auto loans or some other asset category or borrowing category, well, if you've lost your job, you just simply can't pay it. Or even if you maybe still have a job, you're trying to increase savings or pay down other debts, et cetera. So then at that point, the loss falls on the bank. And so the consumer is kind of, that damage is done, but now the loss falls in the bank. And the question is, how solvent are the banks? Now, okay, the Reserve Bank of Australia can print money and bail out the banks if they choose to, although that's a pretty unpopular option. That happened in 2008. Australia was not as badly affected in 2008 as say the United States or Europe or some other areas. Canada also held up fairly well, but they may not be quite so lucky this time. Well, if you start bailing out banks, you're talking about political ramifications, social unrest, et cetera. If you have to nationalize the banks, let's say, and wipe out equity, give the debt holders a haircut, re-IPO them perhaps, these are major disruptions and could result in banks being closed for some period of time. So it doesn't have to be a sort of full on ICE 9, although it could be on a global basis. But you can have major disruptions even in a single country if their banking system is under that kind of stress.
Nick, what are your thoughts on that?
Yes.
Your perspective based in London.
Yeah, so there's a reason why banks need central banks and deposit insurance to back them up. It's because they can fail catastrophically. They can implode. And from the Australian perspective, that did happen in 2008. It just happened in a secret way. So the Australian banks were some of the first to request bailouts from the Federal Reserve, and they did that through their branches in the US. They may be doing that now because it wasn't discovered until a long time later. It was actually an American piece of legislation that forced the Fed to publish who had requested the bailouts, the backdoor bailouts. And it turned out that the Australian banks were top of the list, two of them in particular. So this is a very real threat. It did happen not so long ago, and the conditions this time around are worse.
Right, and just to add to that, Woody, when you look at the kind of banking system collapse, well, just in the United States, our Federal Reserve has already, just now in the early days of this crisis, they bailed out the so-called primary dealers, so the ones who make a market in government securities. They bailed out the commercial paper market. They bailed out the corporate bond market. They bailed out the municipal bond market, and so forth. Set up term asset lending facilities. They're now in the process. Basically bailing out the world through these swaps that we just talked about with a longer list of foreign central banks. So the Fed's bailing out everything. And by the way, don't call this stimulus. This is not stimulus. This is not going to get the economy going. They're just keeping the lights on. They're doing what they have to do. I'm not criticizing anybody, except I could go back 12 years and show you how we got here. But you have to do this. But all they're really doing is keeping the lights on. They're keeping liquidity flowing. They're keeping the plumbing from getting backed up, if you will, in the global financial system. But that's all. I mean, so maybe they've stopped the bleeding from a liquidity point of view, at least temporarily. But that's not stimulus. That's not going to get the economy moving. That's not going to restore confidence. So this is, when I was a Boy Scout around 10 years old, I learned how to fix and apply a tourniquet to someone who's bleeding to death. Well, okay, tourniquet might stop you from bleeding to death, but it's not going to get you back on your feet anytime soon.
Yeah, well, it's the reports lately of these I say stimulus in quote marks because, as you say, they're not really stimulus packages, but Australia 330 plus billion. I mean, that's across the federal government, the RBA, and the individual states. That's what they pledged to fight this thing. Obviously, that's a drop in the ocean compared to the US. I mean, you're talking multi-trillions. I mean, what's going to be the outcome then? If these measures aren't going to work, what are they going to lead to?
Well, what they are is a temporary fix to mitigate some of the worst damage in the short run, but they are not going to lead to growth. And by the way, when you say multi-trillions, just to put that in perspective, our Congress passed a law just a few days ago setting up a $2.2 trillion rescue fund. So this is $50 billion for the airlines and $100 billion for hospitals and $350 billion for small business loans, et cetera, an enormous amount of money. But buried in that 2.2 trillion was 425 billion for the Treasury to recapitalize the Federal Reserve. Now, I've said for a long time, the Fed, as I just mentioned, they guaranteed commercial paper, corporate loans, primary dealers, municipal bonds, corporate bonds, et cetera. They're guaranteeing all these markets, but who's guaranteeing the Fed? Who's bailing out the Fed? Well, we just found out it's going to be the United States Treasury. And so they're putting $425 billion in new capital into the Fed. So think of that as a Fed bailout. But of course, the Fed operates like a bank. So they're going to leverage that 10 to 1. So they're going to take the $425 billion in new capital and turn that into $4.25 trillion of money printing. So you have to take that 4.25 trillion, add it to the 2.2 trillion from the Congress. You're really looking at closer to $7 trillion of direct loans, because the reason the Fed's going to leverage the balance sheet is because they're going to buy loans. So you're looking at a $7 trillion injection. The Fed balance sheet is already past $5 trillion. Now, bearing in mind, after the 2008 financial crisis from 2008 to 2014, the Fed balance sheet peaked around $4.5 trillion. They're already past $5 trillion. They're on their way to $7 or $8 trillion, more than doubled where this whole thing started. Is there some limit? Well, there's no legal limit, actually, but there could be a psychological limit. There could come a time when people just wake up and say, "Hey, I don't know what's going on, but this is ridiculous. Get me out of the dollar. Get me into, gold or land or natural resources, anything, but get me out of the dollar." We may find out the hard way that point exists.
Nick and I were talking just yesterday in preparation for this conversation, and we, as you're talking about the US packages that have been agreed in over there, what does this do? Let's bring in Trump a little bit while we're on that topic. Nick, I mean, what does that do for Trump's chances, do you think? I mean, that's what the latest monthly issue in Strategic Intelligence covered, right?
Yeah, so it's a really strange situation because you've got the government, forcing the economy sort of into lockdown, and then that necessitates a government bailout. So the two together, only make sense with each other. But the problem is, all of this is going to lead to political backlash because it is in effect a bailout, and bailouts are not politically popular and feasible in an election year. So the question becomes, with the election cycle coming up in the US and the US economy and the US financial markets dominating everything, what will happen between presumably Joe Biden and Donald Trump? And Jim, you've recently covered this in the monthly issue, so why don't you take it away?
Sure, and I don't do politics as a lead subject. I kind of keep out of it as much as I can. Say, hey, vote for whomever you want. That's not my job to, promote one candidate or the other. But the linkages between politics and economics are so dense. It's so densely connected at the stage that you have to talk about politics if you want to understand economics and ultimately capital markets. So. That's right. I mean, I have a model that based on predictive analytics that's proprietary that I use to forecast U.S. election results. And of course, famously in 2016, when Hillary Clinton was given a 92% chance of winning, I actually was on nationwide television in Australia with our friend Tiki Forward, and she asked me who was going to win. And I said, Donald Trump. I said, it'll be close. We'll be up late, which was true, but Donald Trump would win. And I said that on other broadcasts as well. So until about 6 weeks ago, that same model, which of course I update, showed Trump with a 74% probability of winning. But there was an expectation that would get closer to 90% by election day. Well, that's out the window because the key variable, the key explanatory factor was no recession. So if the odds of a recession were less than 20%, then Trump's odds of victory were upwards of 80%, or in my case, 74%, because one was just the inverse of the other. Well, now the recession's here. In fact, a depression is here. That doesn't mean Trump's odds go to zero, but what you do with this method, you reset it at 50-50, make it a toss-up, and then you update as new information comes in. Trump's not being blamed for the virus. He's not being blamed for the pandemic. He will be judged on his response function, not that he caused it, but how he handles it. That's how he's being judged. And, a few blunders here and there, that's always the case. But on the whole, he's doing a good job, and the American people see that. But my point is, If you're 50-50, that means it's kind of a toss-up as to whether Joe Biden becomes president. That's new. Now, the market is working very hard the stock market is working very hard to discount the effect of the coronavirus. That's difficult because no one knows quite how bad it will be. Also, discount the effect of the new depression, of the economic drawdown. That's even more difficult because we haven't seen anything like this within living memory. And it's also a moving target. It keeps getting worse. The one thing the market has not tried to discount, but will very shortly, and this is another headwind, is the prospect of a President Biden, because Biden's platform is higher taxes, more regulation, and the Green New Deal. Well, that if you just had that to worry about, that would cause stocks to decline on top of all the other bigger problems you already have. So there's just that's what's one of the reasons, not the only one. I see stocks are far from the bottom. They will come down a lot more because they haven't even begun to factor in the prospect of President Biden.
Well, Jim, so that sort of leads nicely into my next question, really. In your books, we pride ourselves at Strategic Intelligence for trying to anticipate events and be 2 steps ahead of everyone. And that's kind of what you've been doing over the last decade with your books. I mean, currency wars came out while globalization was still really the idea of the day. The death of money came out when QE was fueling the new bull market, really. The big drop described exactly the experience, the crash that we're experiencing now. The new case for gold was published before gold really truly established its bull run. The road to ruin described how governments would react to the next crisis. And now we have your new book, Aftermath. So in the spirit of trying to stay 2 steps ahead for your readers and your subscribers, are we on track for the money reset anytime soon? And what does the world look like after that?
Right. And you're right, Woody. The irony of writing these books is they were all intended as warning, not just warnings. They were certainly intended as warnings, but they were also intended to help people get ready for what was coming. I mean, I was recommending gold at $1,100 an ounce, then $1,200, $1,300, $1,400, $1,500, and everyone yawned and didn't buy it. Now all of a sudden it's $1,600. Everyone wants it, but you can't get it. I mean, the mints are back ordered. The refiners in Switzerland are closed. Some of the logistical operations, you can't get physical gold.
Huge backlog in Perth Mint as well.
I'm not sure of the status of the Perth Mint, but I believe they are back ordered. I know the U.S. Mint is back ordered for the rest of the year. So they're still producing gold coins, but they're all spoken for. If you have a new order, they won't return your call. So it's, and people would say, well, Jim, why don't you, if you wouldn't mind, call me the day before the crisis hits and I'll sell my stocks and buy some gold. And my answer was, first of all, I won't know the exact day. I'll tell you what's going to happen, the order of magnitude. I won't know the exact day. If I did, I might be a little busy myself. But the real point is, what are you waiting for? When the crisis comes, it's already too late. The market has gapped down. The gold's not available. The time to get it is when things were still relatively calm. But it's not too late. Because gold is going to go much higher and stocks are going to go much lower. And even though we've had some of that adjustment, it's not by any means done. So yeah, leaning forward a little bit and seeing what's going to come next. Unfortunately, these complex systems have a way of crashing into each other. My example is always March 2011, the Fukushima disaster in Japan. You had an earthquake that turned into a tsunami, that turned into a nuclear meltdown at a power plant, that turned into a stock market crash. So you had 4 separate systems, seismology, hydrology, radioactivity, and capital markets, normally independent of each other, but one complex system crashed into the other. We're seeing something like that right now. So pandemic, just epidemiology by itself, is a complex dynamic system. It has now crashed into the economy, and we're in a new depression. That has crashed into the political arena, which we just talked about with Nick, with the prospect of a President Biden. But it'll go further. And unfortunately, the next problem I see is actually social unrest, that the economic The unfairness of what happened in 2008, that memory is still fresh. Every day people suffered. The big banks and the elites were bailed out. Jamie Dimon still got his bonus, even if you or your next door neighbor were unemployed for years. So that anger is still there. Now comes another wave, even worse. And as we start to see something similar, where the rich are fine, but everyone else is suffering, you may see demonstrations. You may see riots. Let's see what happens this summer at the conventions of the political parties. Hopefully, nothing in the streets, but you can't rule that out. So I do see some kind of social unrest coming in. But again, these are reasons to have some physical goals, for example, because one of the things I like about physical bullion, it's not digital. You can't hack it, you can't freeze it, you can't block it the way you can with other digital assets. There are a lot of Americans now racing down to the bank trying to get some cash. They want some physical cash, in case the power grid goes out or, electricity goes out, the gas pumps don't work, et cetera. ATMs don't work. What they're finding is they can't get their money. You walk up to a teller and say, I'd like $10,000 in cash, nice $100 notes or whatever. They'll tell you to come back, make an appointment, come back next week, or I can't give you all that much because, we've got other customers asking the same thing. So I like to say, people say they have money in the bank. I say, well, once you put your money in the bank, it's not your money anymore. It's the bank's money. And they'll give it to you if they feel like it. So that comes as a rude awakening to a lot of people. So all of this could be pointing towards social unrest on top of the economic crisis that we're already in.
And I guess the way to just round that off is that, the last time this big seismic change happened, we had the Bretton Woods, really, didn't we? Is there a parallel to back then? I mean, that was really seen as a way of the elite to try and regulate the system and create some cohesion and stability in the system. Would you say that the next reset will be more about control?
Yes, and the reset is coming. I'm not saying it's going to happen tomorrow or next month. The first line of defense, although I think it won't do much good, is coming from the central banks and fiscal policy and monetary policy. So, as I mentioned earlier, we're going to see $4 trillion of money printing from the Fed, and we're going to see $2 or $3 trillion of additional deficit spending. That's on top. We were on track for $1 trillion deficit in fiscal 2020 anyway. Now put 2.2 trillion on top of that, and the Congress is already talking about another bailout bill, perhaps $1 trillion or more. So we might have $5 trillion of deficit spending, $5 trillion of money printing, but all that combined won't work. And so 6 months from now or a year from now, we'll still be in an economic funk, at which point, if there's still this demand for liquidity, is still a U.S. dollar shortage, you may see the IMF step in because they have a relatively clean balance sheet. The Fed is was so badly leveraged, as I say, they had to recapitalize it with $425 billion. But, and by the way, other central banks are no better off. If you look at the ECB or the People's Bank of China, or the Bank of Japan, they're even worse than the Federal Reserve, believe it or not. So, so when that's at its limit, when that's run its course, the only entity left in the world with a clean balance sheet that can print money is the IMF, the International Monetary Fund. They can print a form of world money called the SDR, or the special drawing right. It's a geeky name, but it's geeky on purpose because they don't really want people to understand what it is. Well, what it is world money from a world printing press. And that can come, but to do that, you're going to need the approval of the executive committee. And China, Russia, and a few other BRICS, and Venezuela and other, kind of rogue nations or adversaries of the United States collectively can block that from happening unless their conditions are met. And one of the conditions could be, okay, fine, we'll approve the printing of the SDRs, but you have to agree that the SDR is the new benchmark global reserve currency. It doesn't mean the dollar disappears. If you can't fly to the United States, you'll still need dollars. If I go to Mexico, I need Mexican pesos, so the dollar will be a local currency. But important things like the price of oil, earnings of the 100 or so largest global corporations, settlement of balance of payments, differences or balances, denomination of reserve positions. These will all be settled and stated in SDRs, in this world money, and that will be the price of getting the printing presses rolling at the IMF. So that's a monetary reset, even more significant in this way than the Bretton Woods standard. Now, will it work? Different question. I'm doubtful, but I believe it will be tried. And to be tried, you're going to have to run the dollar off the road to get the printing presses going on the SDR.
Well, I guess that brings us to how you prepare and what you can do. Now, Nick, the portfolio of investment solutions that you select and oversee for Jim's advisory here in Australia has been holding up pretty well through this crisis. Obviously, no guarantees anything will continue, of course, but you've also authored the special Australian chapter of Aftermath aimed specifically for Jim's Aussie readers. So what are you telling readers specifically to do with their money in the midst of all this?
Yeah, now that COVID-19 is the dominant news story, just as social distancing is the solution to the virus, I see financial distancing as the solution to what's happening in financial markets. So basically what I think subscribers should be doing now is moving their money into investments that are not directly connected to the financial system. Now, that doesn't mean sell everything and run for the hills. That means have some of your wealth exposed to non-financial assets that don't rely on a counterparty to pay out on claims. So when you invest in the stock market, you rely on the company's management to do that bit. You rely on the stock market to be open. You rely on your stockbroker to do what you're telling them to do. And there are investments that provide decent return, which don't require all of those counterparties, that you can hold the investment in your hand. So there's no one that you need to rely on for that investment to perform in the way that you intend. So a lot of the recommendations that I see as coming alive right now, and obviously people should have bought them already, but for the newer subscribers, the things that they should be focusing on are non-financial assets like the ones that we detail in that bonus chapter of Aftermath.
That's great. Thanks, Nick. And I think that's probably a good place to end. We've gone on for 30 minutes now, and that's a good time to end. So thank you both for making the time to have this conversation. It really is appreciated. As I said, Jim, you've been anticipating this crisis for many years, and now it is actually playing out. And I know you're in very high demand, but you're always very gracious with your time and your knowledge. And I think all of your readers and all of our strategic intelligence subscribers will really appreciate the thought that you put into your comments, and to you, Nick, too. So thank you both. And stay safe.
Right. Thanks.
Hi, James Woodburn here, publisher of Jim Rickards Strategic Intelligence here in Australia. As you've seen, Jim's been one step ahead of mainstream analysts through the entire COVID-19 crisis. He predicted it would be a global catastrophe in early February, well before markets caught the fever. So what does Jim see happening next? Well, as he just told his US publisher Pete Coyne, complete monetary system shutdown. At the end of such a scenario, the entire global financial system shuts down and any Federal Reserve intervention may no longer be effective. It's worth pointing out that this is a scenario Jim has highlighted for several years as the bookend of this historic bull market. The difference now is it appears to be in motion. So what can you do to shelter your wealth here in Australia? Jim and his team suggest a variety of possible protection measures, and they've outlined them in a brand new financial pandemic shelter report now available to every Australian concerned about where we're headed. Simply click the link below this video and you can get access right now.